Let's start with the top line then. What is the health status of ASEAN's banks broadly?
Hi, thanks, Tom, for having me. The ASEAN banks are reasonably in a challenged position right now. You have some markets like Vietnam where things are fantastic. Singapore, things are starting to improve. But rest of the markets, Indonesia, Philippines, Malaysia, Thailand, there are varying degrees of asset quality risk. And that will take a while for the banks to navigate not only 2020, but a part of 2021 as well. So the way we are thinking about most of the market is we would be looking to build positions for the long term in Vietnamese banks, in select Singapore banks, whereas for most of the rest of EM ASEAN banks, we would be more keen to be very selective and be more opportunistic on trading around those names rather than building a position for the very long term just yet.
Okay, so caution, you talked about asset quality. Of course, that's absolutely central given the economic contractions we've seen in economies around the world, this region included, of course. Which banks then are best placed to handle bad loans at this point?
So Vietnam, as I said, because the growth in that market is fantastic. Singapore increasingly is looking better. The domestic activity in Singapore is holding up well. Slightly out of ASEAN, but select Indian banks are starting to look pretty good. But the rest of the ASEAN banking market, you have varying degrees of risk. But what we do have in every ASEAN market, there are one or two banks which have a pretty good 20, 30-year track record of asset quality delivery. They have good deposit franchise. And those are the banks which we would be looking to buy for the long term. But on general, as a thumb rule, we would be more looking to trade most of the broad banking sector in ASEAN with preference for Vietnam and Singapore banks.
And we have seen here in the region some debt reliefs that are set to expire next year, Harsh. Are any banks in need of capital raising? And if so, which ones?
Yeah, so see, you're right. Some of the Indian banks have already raised capital, and some of the ASEAN banks are raising debt. But we don't really need capital raising per se. Dividends have been cut, buybacks have been suspended, and we are getting even whatever dividends are being paid, we are getting dividend reinvestment plans or scrip dividends coming through. So they have gone a long way in allowing the banks to preserve capital. There may be one or two banks which are slightly weaker, and we have seen some of the mergers as a means of reducing that capital risk. But by and large, I don't see very widespread asset quality, as in widespread capital raising because of asset quality issues. And that's simply because compared to 2015 and 2008, we are in a much better position. The regulatory preparedness for an event like this was way better. So do not see widespread capital call at this point in time.
And Harsh, you have a line coming out that we're showing right now about Indian banks, which you're quite positive about, saying that they should meaningfully outperform Asian lenders over the next few years. We have a chart just to show our viewers about just the NPL situation in India, which of course far outstrips China. I know this is more just the headline figures, but what are you seeing there? What supports that kind of thesis now?
Yeah, so Indian banks are at a very interesting point. See, the thing with Indian banks is large corporates in India have deleveraged meaningfully in last 10 years. The leverage is close to 20, 25, 30-year lows. That's one. Second, the consumers in India who are part of the banking system are just the super prime consumers. These are the top 3% of households of India. And these are the guys who can work from home, telecommuting, all of that, white collar mostly. So that cash flow impact on these borrowers is relatively limited. And the small and medium where risks have been elevated, we have seen very significant tightening of loan to values and different credit metrics over the last 3 years. So we have a two-track banking system in India. You have 4 or 5 banks which are in a very good position, and then you have, let's say, a lot of public sector banks largely and a couple of private sector banks where risks are meaningfully higher. So again, we have to pick and choose, but some of the large corporate banks in India are very well positioned to outperform, not only now, but as re-leveraging happens. It starts now and it goes on for next few years.
Harsh, how much scope is there for consolidation in the banking sector, particularly in markets like Thailand, Malaysia, the Philippines?
Yeah, see, some of the consolidation has been happening, Tom, and the reason consolidation has happened, 2 reasons. One is asset quality risk has come through. Some of the capital-related risk have come through in some of the markets, which forced some of the sellers to basically either put in money or basically sell. That was one. Second, the regulatory priority when you are going through a high-stress situation shifts more towards limiting systemic risk rather than anything else. And as a result of which, you got very quick regulatory blessings to get the deal done. My sense is most of that is hopefully behind us. A period of high stress is hopefully behind us. So we should not see any meaningful deals at a short notice. Now, that's one. Second thing is fintech. With technology now becoming a big enabler of improving my distribution reach as a bank, it becomes rather tough to justify a high-priced branch acquisition, a branch-heavy acquisition. Branches are important, but not as much as they were 5 years ago. So unless the pricing is very good or the strategic fit is absolutely fantastic, I do not see a lot of deals happening. You will see some plug-in deals, but
Mention about fintech. I mean, we've seen a lot of these Chinese tech players like Ant. You have TikTok owner ByteDance, Tencent-backed Siemens. What are the chances, do you think, these players are going to be able to get some type of digital banking license in Singapore? And how big of a threat is it for some of these big players like DBS and OCBC?
we are seeing MAS is evaluating a lot of bank license applications, wholesale and retail. We should get outcome in next couple of months, I guess. And see, what I would say is this: all of the applicants have had applicants and the consortiums, the partnerships they have built up, have their own unique competitive advantage. So that's fair. But what is probably underappreciated is across the region, and I can say that with high degree of confidence, Singapore incumbent banks are probably the best prepared to take the digital banks, challenger banks, head on. Because these banks have been preparing for this eventuality 5-7 years. They have built their capabilities, and some of them are best in class. So I am not as nervous, but I agree that with every new competitor, every well-prepared competitor, the complexity of running the business increases. But I think Singapore banks have done a fantastic job, and I don't worry too much about them getting sidelined. Yes, there will be marginal competition in certain areas. What I'm very keen is, and it will become a more vibrant market, especially the retail digital banking market, and which competitor brings what to the table. We'll see as we go along. I'm looking forward to that competition in some senses, but I'm not getting worried for the income